So it looks like cheap money is about to make its official return. Cheap money, for those of you that may not know, is basically when the Federal Reserve cuts their interest rate and also does something known as quantitative easing. Now, for those of you that might not be aware, quantitative easing, the first time it was actually used in the United States was during 2008, or trying to recover from 2008. So it's actually a relatively new thing, used first in the Great Recession. With that said, it had been used in Japan right before the turn of the century. But in the United States, it's relatively new. Now, what is it? Well, basically, you have quantitative easing and quantitative tightening. Quantitative tightening is when the Federal Reserve pulls money out of the market by selling treasuries. Now, the Federal Reserve has always done this to a degree. The terms quantitative easing, quantitative tightening basically means that they're doing it at a much higher than average level. So quantitative easing is the opposite. It is pushing money into the market by buying treasuries. They also buy other things, other types of securities. So that is the general thing. Now, what it does is it makes capital significantly more accessible because there's more of it floating out in the sorry if you hear noise. Come here. Come here, little rat. Come here. It's my puppy. She's being crazy. Come here. Come here. You want to say hi? Come here. Come say hi. Come here. Come say hi. If I don't give her my entire undivided attention at all times, she throws a fit. So, okay. Run along, you little rat. Run along. Anyways, so what does this do? Well, it makes capital more easily accessible by the average person, by businesses, by tons of other institutions, which of course does one major thing. And that's kind of what I want to talk about in this video. It is inflationary by nature, by its very definition. Remember, there are two types of inflation. There's price inflation and monetary inflation. Price inflation is what we all experience. That's the increasing prices. With that said, monetary inflation, that's true inflation. That is an increase in the money supply. So what this does is this increases the circulating money supply. And of course, that's going to put inflationary pressure on prices. And not only prices of things at the grocery store, gasoline for our cars, electricity, etc., but also asset prices. So the stock market, real estate, and you've probably been hearing all over the place about gold. Gold crossed the $4,000 threshold, and that's really twofold. One is because, yes, people are fearing U.S. Treasury bonds. People are not trusting U.S. Treasury bonds as much anymore, and that is tied into inflation. It's also tied into the massive amount of national debt that the U.S. is carrying. With that said, there's another reason, and that is just inflation in general. When inflation is on the rise, or inflation is likely to be higher than average in the long term, people rush to gold. Investors rush to gold because gold is an inflation-protected asset. It tends to outperform inflation, or at the very minimum, keep up with inflation. You're also going to see this in things that are physical assets, like real estate. Real estate is very likely going to increase in price, not because the market is doing great. Right now, real estate is not doing fantastic, but simply because inflation is on the rise and you're going to have quantitative easing in the very, very near future. Now, a lot of economists thought that this quantitative easing would take place in 2026 at some point, but you'll see institutions like Bank of America, JP Morgan, revising their estimates in the coming months that it will likely happen either at the end of 2025 or at the very beginning of 2026. So why is this happening? Well, it's happening because the Federal Reserve understands that this economy, this most recent cycle, which I would call it, I mean, it's kind of really two cycles, but since 2008, really, the Federal Reserve pumped a ton of money into the economy to save the economy from the Great Recession. With that said, ever since then, we have had an economy that's built on a house of cards, just to put it in simple terms. It is a fragile economy built on cheap money. So when you have interest rates at 4%, which is not high historically, but the Federal Reserve has had interest rates, their FFR, at 4%, slightly above it, and it's wreaked havoc on the jobs market. Now we're seeing revisions in the jobs market, one after the other, which is very clearly showing that the jobs market is not as strong as the data suggested. And that is because this economy is built on very cheap money. So when you remove cheap money, even though 4% is not that high, things start to fall apart. So the Federal Reserve is going to be forced in the coming months to change that. It is going to happen, and that is why they're already cutting their interest rates. They're going to cut it again just in a couple days. I will provide you with an update at their next meeting, and then they're very likely going to cut it again at the next meeting. So without risking dragging this video out for too long, the fact of the matter is cheap money is here. So how can you protect yourself from this? Well, you can buy inflation-protected assets. That is stocks. Stocks always perform well when the Federal Reserve cuts rates and injects liquidity into the market. Real estate, if you're able, is going to perform well. Gold is theoretically a good asset. And I'm not going to make a video on that because there are tons of videos already saying how much gold is going to go up. With that said, I understand. And this is the one thing that I really want to make clear here, that a lot of other channels don't make clear. I understand that right now, most Americans can barely get by. Okay, so for me to come on here and harp that you should be investing in real estate, stocks, gold, etc., it would be out of touch with reality for the average American. The average American, potentially even you, and if this is you, that's okay. It is not your fault. It is the fault of this economy that is built on a house of cards. But for the average American, that's not possible. For the average American, they're going to bear the full brunt of inflation because they cannot afford to buy gold or to buy stocks or to buy real estate, right? The average American is barely getting by. And if you rent instead of own, or you really can't put more than a few dollars into your retirement account every year, if that, just understand you're not alone. Understand that this is the majority of Americans. And unfortunately, it is built into the system, whether that is by design on purpose to completely continue to bridge the gap between the wealthy and everybody else, or if it is a tragic accident of capitalism, it's happening. So unfortunately, the average American is going to bear the full brunt because it is very difficult to invest a significant portion of one's income into inflation-protected assets, and that is why the wealthy keep getting wealthier, because they inflate away their debt, which is what the U.S. government is also doing. They inflate away their debt that they use to buy the assets, to buy the real estate, to buy the stocks. Some of these people take loans against their assets and their stocks, these very, very wealthy billionaires. And then when inflation comes in, that debt is dollar per dollar worth less, while the average American gets screwed. I'm not going to drag this video out for too long. You know where I stand when it comes to this. The system, while it is what we got, I'm not saying that, I always say, you're not here to change the game, you're here to get good at playing it. With that said, it's a rigged game. It's an unfortunate game, and it seems like it's getting worse every single year, and something has to change. If not, the entire system is going to break. With that said, if you like personal finance, world economics, and investing, you're in the right place. I don't think I said this at the beginning of the video, but my name is Derek. I got my degree in finance. You don't have to. I love finance. I have a decades worth of experience talking about this stuff, working in this stuff. Finance and economics, I know like the back of my hand, and I love being able to share that with you guys. So if that's something that you're interested in, you are in the right place. I usually do weekly videos here, but lately it's been way more because there's so much to talk about economically. Please consider subscribing if you haven't already. It helps the channel tremendously. Every subscription means the world to me, and it helps the channel grow. It's difficult to grow here on YouTube. With that said, hope you have a fantastic rest of your day in this crazy economy, and I'll see you in the next video. Take care.